So today we'll be looking at the valuation of securities, valuations of securities. We'll be looking at issues of dividends and the like, and the main and other things that we're going to tackle today. Okay. Okay, so we'll be looking at the valuation of securities. This is on the theoretical approach. Adam, you can still record using your Skype so that you have immediate access to your videos. Hi, Adam. Yeah. Okay. Okay. Because Mumeka was requesting for the video. Marus is like he's on his way. I don't know where he's going. So you want to be able to attend. Okay. I like the painting behind your. I always like this painting. It's very iconic, huh? Okay. So it's the valuation of securities, the theoretical approach. That is what we'll be looking at. So as an intro, we'll look at what in theory, not in practice. This is why after this topic, we'll have to find time to look at the next topic. Will be on not theoretical approach, to be on valuation of securities, but now the practical approach. Here first we are looking at what does the theory say, because ideally I think we are dictated by theories. So I'm saying that time is the market value of equity and of debt. It is this theory which forms the basis for most of the arithmetic that is generally required in the examination in questions on this area. So most of the things that you examined that you examined in this particular course, it is not the practical perspective, it is the theoretical perspective, and this is why it's so important that we actually ground ourselves with the theories nicely. We know that in practice many other factors are likely to be relevant, which obviously we'll be covering in the next topic. Like I told you, we'll be looking at securities, valuation of securities in practice, not in theory. The valuation of equity, constant dividends. You first need to understand that the fruits of any investment is dividends. The fruits of any equity investments, I have to emphasize on this. The fruits of any equity investment is dividends. You might not believe this, but most of the people that invest in equity shares, say like for not Zamefa, what is that thing? What is this company? I always forget in dollar. What is this name of the name of the company? The one that deals with that is in forest. What is the name of the? Oh, just sorry. In the copper base, sorry, not in dollar. Not Zamefa. Yeah. Hello? Yes, one. Hi, how? No, you can just put N of the two. But I would suggest putting the one for contribution, because once you put the one with contribution, then it is indirectly looking at cost as well. Okay, that's. There's one company in the Copper Belt. It's a government company. It's a parastatal that is about to list on a stock exchange. It deals in forest issues. Not Zamefa. What is this? Zafico. Yes, Zafico. So as they do the prospectus, advertising the newspapers, finally do an initial public offer, a number of investors, a number of you will be buying shares in Zafico, will be buying shares with a view that you are actually going to have some meaningful returns in dividends. So as you are actually doing that, you do not expect that the dividends, they will be fluctuating. What is in your mind, what is in your humble mind, is that the dividends actually they will be constant, or better still, they will be growing, isn't it? This is why you would want to invest in Zafico. But the reality is, sometimes the companies may not even give you the dividends that you need, as long as they still want to satisfy their investment desires. It might even take 5-10 years. They will not give you the dividends. They will not declare any dividends. But that does not make you feel like you're not going to get dividends, because you can manufacture your own dividends by selling your shares, some of your shares, on a secondary market. So I think the market value of a share is effectively determined by the shareholders, and that is what it is. It is the price that shareholders are prepared to pay for a share on the stock exchange, with a view that they will be able to get meaningful, well-defined and structured dividends. So I think in theory, the amount that shareholders are prepared to pay depends on two factors. So if you are to be asked on how the values, how the shares are valued on the market, when we do our market capitalization and all these things, there are only two things. One is the dividend that they expect to receive in the future. That is what ideally Martha led you to buy those shares, small shares you bought. Was it at Zanaco or that sugar company? So Martha went to buy those shares. The moment they did an initial offering, I don't know if it was Airtel or what, Martha was courageous to buy shares. Martha, up to date, Martha is waiting for dividends that she has never seen. Until Coach Carter told her, Martha, you can manufacture your own dividends by selling shares on the secondary market. By then, Martha didn't know about secondary market. Martha didn't know about the alternative investment market. But she came here, and as consultants to Martha, we helped Martha to say, Martha, you can now sell these shares. But many investors like Martha believe that they will need to get these dividends. So, by believing that they will have to get future dividends, that in itself gives the value of the shares. There's some intrinsic value generated by the investors who believe that at some point they will be given dividends. That's the first point. So I think the dividend that they expect to receive in the future, that will determine the market value of the shares, of a share. Secondly, the rate of return that shareholders require. If you look at the relevant dividend theory, dividend irrelevant theory, when you look at it clearly, what it just tells you, maybe not clearly so, but what it does tell you, that you see, the whole theory about dividends is irrelevant. Because in any case, once you have invested, it doesn't mean that you should get dividends. So even if you don't get the dividends, that money is still going to be plowed back into the company, and they are going to generate more or create more value, which at some point your earnings per share will go up. your the market price per share of your share, the value price, your market capitalization as an individual will also go up. So there is dividend irrelevant theory. That is what it says. Then they go ahead and say, even when you are not given these dividends, the companies are not declaring dividends, it doesn't mean that they are not declaring dividends as long as value is being created. So if value is being created, it is wise to suggest that you can manufacture your own dividends by selling some of the shares on a secondary market. But in theory, we are saying there are two factors: it's the dividends and the rate of return. So let's look at the first example. It says PLC has in issue $1 shares and has just paid a dividend of 20 cents per share. Dividends are expected to remain constant. Shareholders' required rate of return is 10% per annum. Let's go this side. So first we have three variables here. So that we don't memorize the functions. It's not good to memorize formulas. So we have three things here. We have a share that is valued at par value. It is valued at $1, isn't it? Then we have another variable that talks about dividends of 20 cents per share. Then we have another variable which talks about the rate of return, which is 10%. So we are saying, in theory, the market value of a share is determined by two factors that are already in that question that we'll be looking at. That is dividends, future dividends. Secondly, rate of return. So now let's look at the question. Let me just cut it here, guys. Cut it. Let me just bring it into Excel. So we are told first, what is the share price? This is what I would even call book value of your share. $1 per share. So your book value is $1. That is your book value. Then your dividend is 20 ngwe or 20 cents, which is this. That is 20 ngwe per share or 20 cents per share. Then you have your rate of return. Your rate of return of 10%. So here now, what it is, we want to find the market value. So the market value of this will be basically dividend divided by your rate of return. Yes. So first thing first, understand that if one has a share of $1, the rate of return of 10% will be what? 1, isn't it? 0.1. So here you have been asked what will be the current market value per share. So the market value per share, I can do like this. If I wanted to show you nicely, I can do like this. I can say X market value, it should give me what? First, if we're using this example, this formula, meaning that we'll just say equals the dividend, which is 0.2, right, divided by the rate of return of 10%. It will give you $2. This is $2 per share. This is the market value, or 200 cents. Or 200 cents. What have I done? Or 200 cents per. Yes, but currently, you know, when they are valuing this, mostly they value them in cents. They're using maybe in ways or whatever. So you can say it's $2 per share, or 200 cents per share. Now understand the concept here. Understand the concept here. If for example you are given a return, your dividend is like this is your total return, which you are actually given as your dividend. So you're saying you have 0.2. Understand this. You understand this. You have, if it's $1 share, or maybe let's say 0.2 as your dividend, and you are saying with this dividend you are actually getting a return of 10%. Understand this, huh? Because let me even face you so that I talk to you nicely. You understand this concept. You don't now need to start memorizing formulas. Here, it's like there's maybe a concept of cash sweep, where we're actually saying all the EBITDA or earnings attributable to shareholders have been given to shareholders in form of dividends, where the dividend payout ratio is 100%. Mrs. Velan, where the dividend payout ratio is 100%, you are not leaving anything for other investments. Hello? You are not leaving anything for other investments. So all you are actually saying is that all the earnings attributable to shareholders, because the earnings attributable to shareholders are in two forms. They are in two forms. There's one that goes directly, that is given as dividends to shareholders, because you have said, you as directors, board of directors, you have no plan for that money. So all you are doing is that, guys, we have made these monies, but we're giving you a portion of this money in form of dividends. The other amount remains to actually fund capex or capital investment projects. So there are two forms. But it's also possible, with this example we have looked at, we are assuming that all the earnings attributable to shareholders have been given to shareholders in form of dividends. So if that is the case, then we are actually saying the 0.2 dividends you are given, it is just 10% of the market value. Then 100% will be zingati. So we go back to that type of mathematics you hated in grade 7. We are saying 0.2. Let me get my tools here. So we are saying 0.2, these dividends, isn't it? The 0.2 that you got is just a 10% of your return, because the return is 10%, right? Then here, this is why you have your 100%. So if you got a 0.2 as a representation of 10% of what you're supposed to get, you've been given that return in terms of dividends, then nchini zingati hapa. I'm just here, I'm a little bit email address here, and I've been struggling to find your. So it's like this. So you remember now what you used to do. So which means it is going to be 10x, isn't it? It's going to be 10x or 0.1x, because that is 10%. So it will be 0.1x, right? Equals to 0.2, because it will be 100 times 0.2 is got 2. So you have something like this. Then now you say x equals to 0.2 divided by 0.1. It gives you $2 per share, which is 200. So meaning the market value will be 200, and this is why we are saying the market value is basically dividend divided by rate of return. But it's coming from this logic. First understand this logic. If you go just direct to this formula, you will not understand the logic. Understand the logic first. Does it make sense now? Adam. Kuno guys nkuziyale kwa. So we have to demonstrate these things. Now we proceed. I know for 13:30 I have another class. It's rough, guys. We proceed. No, not this. So we are saying what would be the current market value per share? We are saying it is 200 cents per share, or $2. Understood, huh? So guys, then we come to this. It says Movita has in issue 0.50 shares and has just paid a dividend of 15 cents per share. Dividends are expected to remain constant. Shares required rate of return is 12%. What would be the current market value per share? Guys, do this just in 2 minutes. Under 2 minutes. Do this, then we'll do it together. But I know you have gotten right. If you have done the correct thing, that should be the number, right? That should be. Yeah. How possible? Okay, I'll say this is example 1. It's the same things. They'll only put a number of things there. You see, they'll put a number of things, a number of all these topics, because it will not just be a small topic. This is why we have to be done with this syllabus, so that now we can start looking at examples. Yeah, but it's the same thing. Right. So we are actually looking at dividend, which is 15. Yeah. Okay, I'll just do like this, $0.15. Then you are looking at the rate, which is 0.1 ton. So your market value is basically your dividend divided by the rate. But at least you know how this thing comes about. If someone was to ask you to explain, you know why you are doing this. It's coming from this explanation that we did here. That is where it is coming from. Right? Okay, now guys, if you remember, there's a question that I gave you on PE, that is price per earnings ratio. There was a term on CAMDIV. I don't know if you still remember, and I'm still waiting for that. But I didn't want to bother you so much. I know I will receive my work. We normally use CAMDIV and XDIV. Okay. So first we have to explain what this thing is. Yes, in both the above examples, we assumed that the dividend there was XDIV. The company just paid the dividend, and therefore anyone buying the shares would have to wait for a year until they were to receive their first dividend. What we looked at those two examples. The assumption that was there is that the company had already paid the dividend. So if one buys shares today, has to wait for another year to receive dividends. And we call it as XDIV. That is how we call that situation, is XDIV. So we're saying, and therefore anyone buying the share would have to wait for a year until they were to receive their first dividend. In the examination, we ignore the possibility of interim dividends. That is what we ignore. So you cannot buy shares today, after 2 days you receive dividends. If that happens, that will be called CAMDIV. And your shares, they will be slightly expensive than the one who is actually buying them on the understanding of XDIV. How lucky would you be, Adam, where you buy shares this month, following month you are given dividends? As a shareholder, you never contributed to the success of the company. You were not instrumental in deciding who sits on your board. You were never instrumental on your side in terms of which auditor, independent auditor, will come to audit your books, because that is your responsibility as a shareholder. Remember the principles of corporate governance when you're looking at the roles of the board of directors. First thing first, the shareholders, they appoint board of directors, ideally where there is no corporate governance collapse. The shareholders are ideally supposed to appoint the directors. So once they have these directors, which is the board of directors, which is a combination, it's a hybrid of the executive directors and the non-executive directors. So these directors are the ones that determine the strategy of the company. In determining the strategy of the company, remember that you cannot generate required returns if you don't manage your risk. But there are different types of risk appetites. You have those that are risk averse, you have those that are risk takers. It is the duty or the mandate of the board of directors to determine the risk appetite, because they are the ones who are going to come up with these strategies. They will decide what types of strategies they are going to look at. Is it rational model of looking at strategies? Is it freewheeling? They will decide that. Now we have decided, for example, that we are actually going to adopt a rational model in developing our strategies, or evaluating or sanitizing our strategies. They will say the first thing that we are going to do, guys, we'll look at the position of the company. But in doing this position, looking at this position of the company, first we need to look at the mission. Our mission. Why do we exist as a company? Remember that these topics or subjects you learn, they are supposed to be in real life. It's one course, it's one subject. In the industry, not say, topic here is one course. And they are all integrated. So you have to understand that first you are looking at the mission of your company. The mission of your company, ideally, is this is the rationale behind the existence of your company. Now, in determining why you exist, the purpose of your existence, then now you say, we need to develop a vision. Don't go out there, start your organization, like my colleague who is starting her own TV channel, because she has worked so much with these TV people, so she's starting a TV channel like the Kardashians. So she's starting a TV channel. So first she needs to have the vision. And I would define it like anybody else in the streets, that a vision is just the ability to see above and beyond the majority. But you cannot see above and beyond the majority without having set your objectives. But before you go to your objectives, you need to look at yourself first. This is where now you do your internal appraisal. So with your internal appraisal, you are going to use certain models such as a SWOT analysis. You look at your strengths, you look at your weaknesses honestly. Not if we ask you, what are your strengths, what are your weaknesses, Adam? You start stuttering. No, you need to know your weaknesses. Your opportunities and threats, that is under internal appraisal. Then you move on from that internal appraisal thing. You go to external appraisal. This is where, guys, you look at pest or pest analysis. So you say, we are going to set up this company in this country or in this environment. How is the politics? How is it going to influence our decisions? How is the economy? This is the economic part of your pest analysis. Your interest rates, your foreign exchange, and all these other things. your inflation, how your GDP is growing. You look at all those things. You look at social. These are demographics, where if you're coming up with a product that is ideally for kids, and you go to a place where there are only old people, you might actually end up missing it. Then you look at even technological. You can even go to ecological, you can go to legal frameworks. After you have exhausted your position analysis, obviously you also need to look at stakeholder analysis, where you can use your Mendeley. Then you go to your objectives. From your objective now, you go to strategic option. You list all your options and decide which one you're going to pick under strategic choice. Then now you put your strategy in action under implementation. Then you go and start now looking at controlling your strategy. So what I'm saying, I'm actually saying that these board of directors, they are the ones that will do all those things. Now imagine for once, and this board of directors, they are the ones who have been appointed by the shareholders. They also now do what? Prepare these financial statements. But the shareholders are saying, we don't believe in you as board of directors to give us this information. It might be a bit hooked up. So we will need to appoint our own auditors so that they can give us an independent judgment over what is there, or view or opinion as they call it, a fair view. So now imagine you, who hasn't even contributed as a shareholder, who hasn't even contributed to all these other things that I'm discussing. You pay, you buy shares today. After 4 days, there's a time now to start sharing dividends, and you find yourself in the queue. How lucky are you? But if you find yourself in that particular queue, this is what is defined as CAMDIV. So if it's CAMDIV, it means that the shares that you're going to buy at that, they'll be slightly expensive, because you're also buying, indirectly you're buying dividends in there. Hello? Which you never worked for. That's a difference between CAMDIV and XDIV. Yeah, explain. Yeah, ask a question, Adam. So XDIV, it is where you assume that the shares that you are actually buying, you are not going to get dividends within that particular year because you never worked for them. CAMDIV is where the shares that you are buying, that share price has already put an inbuilt amount of dividend which you never worked for. So your shares will be slightly expensive than normal. That's CAMDIV. But once you find CAMDIV in the exam, please convert it to XDIV and do your computations well. So let's move on. I just wanted to explain about these things because I think it's very important. So I'm saying in both the above examples that we looked at, example 1 and 2, the company has just paid the dividend, and therefore anyone buying the share would have to wait for a year until they were to receive their first dividend. In the examination, we ignore the possibility of interim dividends. We call this situation an XDIV valuation, which I had already explained to you. Suppose, however, that the company was about to pay a dividend. This would mean that someone buying the share would receive a dividend virtually immediately, in addition to all the future dividends. Therefore, the price that they will be prepared to pay will be higher by the amount of the dividend about to be paid. And in our life, we call it CAMDIV valuation. So, if you have a market value which is CAMDIV, meaning that there will be market value X dividend plus dividend about to be paid. That is what makes come div. I've already explained all these things. So let's go to example 3. Hello, yes, Monica. How are you? Again. Fine, thank you. Oh, okay, that's good. That's good. You're submitted, huh? Okay, that's very good. No, you actually, that's why I use the contribution per unit, because in the other question of profit maximization, you had already determined which crop gives you a higher profitability through using a methodology that I explained to you on contribution per unit. If, for example, the scenario had limiting factors, say machine hours, labor hours, then would actually first try to find contribution per unit per limiting factor. The one that would give us a higher contribution per unit per limiting factor is the one that we are going to pick as a profitable crop to invest in. Okay, thank you. Hello? So now, we look at example 3. Try it a bit. It says Beta PLC has in issue 0.50 shares and is about to pay a dividend of 15 cents per share. Dividends are expected to remain constant. Shareholders. But there's a difference. The question has slightly been twisted. Didn't I? Maybe I didn't, eh? Yes. So now you have example 3. Okay, let me just do this first. It's looking the same. Okay, let me just. So let's do this question. The first 2 examples, we assumed that it was what? It was XDiv, isn't it? So we have these same numbers. First, the market value, guys. The market value, this market value is XDiv. This market value is XDiv, where you haven't inflated it. So meaning the CAMDiv market value will be how much? First don't first just shoot matter. First look at the theory that we have explained. Don't just shoot, otherwise the day you become a cop, you will be trigger happy, you will kill so many people. I want the answer here. Hello? Nizinga? Yeah? I haven't said that. Come, yes, 1.4. Now I explain that. Explain it on Sesame. Explain, guide. Explain. So on the CAM div, it will be this 1 point whatever, 1.25 plus the 15. Remember that when they were buying, whoever was buying these shares was buying them at 1.5, not at 1.25, isn't it? Because the dividends were about to be paid. Miss Yane, explain Mchizungu. Martha, she's getting confused. Eh? You're confused. Now you're getting confused. Yeah, what it is, yeah, Martha, you're now confusing your friend. Eh? So what it is that the CAM div market share equals to the X div market share plus dividend. CAM div market share equals the X div market share plus dividend. Let me explain Martha in the language that you understand. How I wish I knew Ndebele. Yeah, you should teach me. So, now in that language that you understand, let me try. What we are actually saying is, you see the market price, the market share. If you are buying these shares with the view that you are not going to get dividends within 1 year at the time that they are declaring dividends or whatever, you are actually going to buy at X div market share, meaning that these market shares, they will not have an inbuilt adjusted value of dividends in it for now and for the future. So they'll be slightly cheaper. And even when the shares are being declared, the dividends are being declared, unagula 2, 3, 4 days, suza diako. Because the shares that you have, they do not have an inbuilt dividend value in it at that time. That's X div. For CAM div, we are actually saying that it's possible to buy shares today. After 1 month when they are declared dividends, now you have kupasako. Reason being that in that market share, they have already calculated the dividends they are going to give you. So meaning that there will be an X market value, X div market value, plus that dividend kuvaza kupasa. So it's like you are buying your own dividend, isn't it, Cecilia? Adam? It's like you're buying your own dividends because there's an inbuilt dividend in your pricing or in the pricing. Hello? Which 0.5? No. If I lack of book value, book value, it goes and sits in the balance sheet. The market value is the one that you use for trading purposes on the stock market. That could be primary stock market and maybe even secondary market. So we are actually saying yes, the book value is $1 per share. That is what is sitting in your balance sheet. Because what sits in your balance sheet is not market values. But then you are also saying yes, the book value is $1, but the market value ex div is $1.25. The market value come div is $1.4 per share. So if you want to calculate, yes, the market share plus the dividend. Because even if I'm using book values to value the company, I'm not going. I won't just look at the share price, which is the book share price. I will not just look at the share price and determine the value of the business. I will look at that under capital there. I will look at capital. Under share capital, I will look at allotted shares. If there are any allotted shares, I will look at revaluation reserve. I will also look at retained earnings, everything that will sit under equity category. Then I'll add it together, remove debt. That is how I would find what we call enterprise value. This is how we calculate enterprise value. That is one option. The other option, I would look at the market value. So how would I do it? I would just I would do market capitalization, where I would look at what is the market value of these shares ex div. Because ex div is original, you have removed my dividends. So I'll say it's $1.25 per share. How many shares do we have? We have 1 million shares. So 1.25 times 1 million shares, it gives me $1.25 million as the value, the enterprise value of this company. I've used two methods. I've used the book values, the numbers that I'm getting from the balance sheet, and I'm also using the numbers that I'm getting from the market. Then I can choose which method I should go for and make a justification to that effect. Okay. So Adam, I think it's clear. I guess it is. Aye. Okay. Almost done with the class show. Time we end there. Look up to maybe 15. Okay. So we looked at this. This was the formula. That was market value come div, because market value ex div plus dividend about to be paid. Which we looked at that. So on the come div and ex div values, QSU there, I think the examination will only be asked to deal with a situation where a dividend has either just been paid or is about to be paid come div. In practice, the next dividend might be due in 3 months' time. This would make the arithmetic a little more involved, but will not be required in the examination, so we will not do that. In the examination, we always assume that the market values are ex div unless you are told otherwise. So we'll end here, guys. Tomorrow, I know today is tricky. Maybe today in the evening we can still meet. So that, there's nothing we are doing. We are in a lockdown, so we can as well just continue learning if you have no maybe at 20 hours if there's no big problem with that, so that we can start looking at the valuation of equity that is non-constant dividends. Or we can keep it today. Let's just rest a bit. That's a day. Is it the day? What is the Easter, whatever? I need to be educated. This day, what happened? Religiously. Yeah, I was in church 15 years, 20 years ago. What is today? What is happening? Mrs. Yamen, you haven't gone. Educate me on this part. A Friday. Yes, Good Friday. So what does it mean? Adam, you're laughing. Okay. Okay, so today please, today is more or less like, is it a celebration or a morning time? More okay, so today then there will be a day that we will be celebrating. Is it a Monday? Yeah, so today being a morning time, let's keep it so. You rest, then tomorrow I don't know what time we can start. Nine, Mrs. Let's start at 9. Aye. 9. So today, please, I allow you to go and mourn. Thank you so much, and have a good Friday. Bye-bye. Okay, please do. Okay. Thank you. Bye.